CPA? And they're like, no, you don't need to know about accounting. So later on, I did get a CPA, and I found it incredibly helpful. So I was thankful to get a CPA, and on top of that, I had a ABV credential, Accredited Business Valuation, which I find really helps me mesh the transfer pricing and the valuation worlds collide together very frequently. And so there are others out there with my type of background, but there aren't that many actually that have that mix of supply chain and valuation and such. So that's one of the things I really enjoy about transfer pricing. It's really the intersection of multiple fields, tax, of course, accounting, legal, business strategy, value chain, supply chain. It's all mixed well. So it's like in the beginning, I started doing benchmarking and comparable searches, and I found that piece incredibly boring just to focus on as a junior analyst on that area. But especially as I went to Belgium and did a 3-year assignment with EY in Belgium, that really opened up the transfer pricing world for me. And I'm really happy to now be a specialist in transfer pricing and valuation. So our agenda today is, there are 4 parts of it. There's whoops, sorry. I am moving ahead here by accident. I'm going to move so I can see the entire screen here. What is transfer pricing? And the second part is why it's important. What types of companies need transfer pricing services? And then finally, we'll wrap up with how we deliver transfer pricing services collaboratively. So we'll start with what is transfer pricing. Transfer pricing, by definition, involves controlled transactions. So transactions between entities that have some kind of related control. If it involves a third party, by definition, that's not transfer pricing, unless there's some kind of control. So most countries require the companies to demonstrate that their controlled transactions are conducted at arm's length. So the arm's length standard is usually what we're striving for, not always. I'll talk a little bit about some exceptions there. When I first started learning about transfer pricing, it was explained to me that transfer pricing is both an art and a science. And I really agree with that. It's of course, a science to it, and understanding the methods and understanding the technical aspects, but there's also an art to it in terms of using some creativity in terms of developing transfer pricing structures that make sense, and to not mechanically apply transfer pricing, because sometimes if you just take on a mechanical type approach, at the end of the day, you might deliver nonsensical results. So what is a controlled transaction? I'm going to give you the US definition here, but I would encourage everybody to look at your own countries and the countries around you, because it seems like there can be some variation around how different countries view control. In the US, it's very specifically defined in 482, which are the US transfer pricing regulations. And the definition includes any kind of control, whether direct or indirect. I underline indirect because that's what surprises people sometimes. Whenever the IRS can show that 2 or more taxpayers are acting in concert with a common goal or purpose, they can potentially use 482 to impose adjustments. A presumption of control arises if income or deductions have been arbitrarily shifted. So it's pretty broad, and it theoretically could include situations involving mergers and acquisitions or joint venture partners. The typical situation would be when you have entities interacting in a common group. That's where you typically see transfer pricing and control. So when do companies need to address transfer pricing? Whenever there are controlled transactions that are international, but there can also be domestic transactions as well. Horacio actually mentioned yesterday that in Mexico, sometimes transfer pricing comes into play domestically. And the same is true in the US, between some states, or even between entities. Let's say you have a control group where one entity is taxable and another entity is a non-taxable type entity, for example, a non-for-profit entity, and they have transactions. That happened to me once. I encountered this once when I was working in the Big Four, and there was a hospital group, and one part of the hospital group was for profit and the other part was not. It had a lab that was taxable. So those transactions between those groups involved transfer pricing, and the IRS did use transfer pricing as the way that they use to evaluate the transactions between those entities. So this slide outlines the types of intercompany transactions that we see, the typical types. These are more the generic that, you can run into some pretty unique situations sometimes. So there can be, I'm going to say that this doesn't capture everything, but it captures, the vast majority. So tangible goods transactions are the most obvious. Those are the easiest ones. Those are probably the lower risk transactions usually, because you can see a transaction, you can see a physical good flowing from one entity to another. The rest are higher risk because there's more ambiguity. For example, with services, what are the services that create value that you can charge for? And then you have different types of services. You have routine services like back office services, accounting and such, or high value services like R&D, services that create a lot of value. Intangible property, Michael Bredal discussed this yesterday at length. And of course, this is really a critical issue in transfer pricing, especially when a company is highly profitable. Usually the high profits of a company, let's say a company is earning more than, let's say 8% or 10% operating margin or higher, 20%, 30%. Usually those types of returns are associated with some kind of unique intangible property or properties. And so there it's really critical to understand what intangible property is being used and which entities own them. Intercompany financing is another area that's important. I see all the time where companies are sending out capital, sending out cash from, let's say, the US to Canada. It's a US parent loaning a Canadian affiliate some cash. It's a loan, but they want it to be a loan, but they don't put in an intercompany agreement. They don't charge interest. There are no terms. All of a sudden it gets recharacterized to contribution of capital. So with financing, a big issue there with loans is a recharacterization of the transaction. Guarantee fees. So those involve situations where, let's say, I'll pick on Canada because that's that is our biggest trading partner. So you have a U.S. company that has a Canadian affiliate. That Canadian affiliate takes out a loan in Canada, but that loan is guaranteed by the parent, which saves the Canadian affiliate some costs in terms of interest. They get a lower interest rate. The IRS wants a piece of that savings. So we have to do an analysis to figure out which portion of the savings should be taxed in the US. And then other types of transactions involving cost sharing and global trading. So I mentioned before that the arm's length principle and the arm's length standard is the heart of transfer pricing. I talk a little bit about OECD and US because in principle, the IRS says quite often that they're completely aligned, but they really aren't. I would say they're mostly aligned, but there are some disconnects. And we could start with how the OECD defines the arm's length principle versus how the arm's length standard is defined in 482. You could see here when you read this in the OECD language, it's broader. It's more relationship based. It's when the price paid between related parties is the same as the price that would have been paid between unrelated parties under the same or similar circumstances. So it involves both behavior and the results typically, whereas the US is more results oriented. So there's a lot more things we can do from a practical perspective in the US that where some certain OECD countries might say, well, that's not arm's length behavior. But in the US, if we could show that the results at the end of the day are arm's length, then usually we can pass muster with that as opposed to sort of a behavior concern that some OECD countries might have. So that's maybe one of the key cultural differences there. Especially when I was in Europe, we did pay a little more attention to the behavior. And for example, intercompany agreements are important everywhere, but it's even more important, I would say, for OECD to have the arm's length behavior around intercompany agreements and such than in the US. So why is transfer pricing important? Well, it's important because it's considered by many, and some of my colleagues might disagree who specialize in international tax and non-transfer pricing, but many of us and many people in generally, including companies, consider transfer pricing as a single most important international tax issue facing multinationals. most tax authorities require the transactions to be arm's length. The company's transfer pricing practices can cause the entity's income to be overstated or understated, and either one is bad. I mean, you can understand that an understated income in a country is can create issues from that country's perspective. But somebody I've heard a lot, I've engaged in a lot of discussions where it's like, oh, we put too much income in the U.S., therefore it should be okay. And I'm like, not necessarily. We've got the other side of the transaction to look at, and more of those entities are looking at the profits that are being attributed to other countries, and they want a piece of it. So understating or overstating profit can be problematic. So this causes multinational entities or enterprises to be exposed to transfer pricing adjustments by tax authorities, potentially resulting in double taxation. So taxation once is hard and expensive, right? But double taxation is terrible. And then non-deductible penalties and interest on top of that. And frequently those penalties will be used as a stick to intimidate companies into going ahead and agreeing to having to pay tax on an adjustment. So that was that's where documentation can come in to help protect companies, because a lot of countries, including the US, have provisions that provide penalties protection if you have the appropriate documentation in place. So I mentioned before, in terms of the overview of transfer pricing risk, overstating or understating operating and taxable income will cause the overpayment or underpayment of tax in one or more jurisdictions. One-sided transfer pricing adjustments results in double taxation potentially, unless you can get relief, which is sometimes difficult to get. There is a potential to get relief through competent authority and such, but sometimes companies just suffer through the double taxation because it's just too expensive. It takes too many resources to pursue the relief. Non-deductible penalties and interest, the unintended transfer of intangibles. So I had a client once when I was in Belgium, where it was a US parent company that had a Belgian affiliate, and they charged this Belgian affiliate a royalty. They also charged R&D. So we told them, you know, when you're charging R&D, you're effectively transferring the ownership of the asset to Belgium because it's paying for the R&D, the underlying R&D that creates the asset. Therefore, you can't also charge a royalty. So those are the kind of situations we can see out there. So in that case, the company was unintentionally transferring the ownership of the IP to its Belgian affiliate. Recharacterizations of transactions, we talked about debt versus equity, for example. And then another situation that causes huge tax inefficiencies is a mix of losses and profits among entities in the value chain. I've seen so many situations where a company might have an effective tax rate that's exceedingly high. I had one company that I was talking to when I was in Europe that had a 90% effective tax rate. And I say, how do you get a 90% effective tax rate? Well, they had tons of losses in some of their European countries and profits in others. And when you do the math, the tax rate can get really high. So a lot of companies, you know, that's where the mechanical part of transfer pricing comes into play, where the company determined what they thought the transfer pricing should be. But at the end of the day, if you take a step back and you look at your value chain and look at the entities that are involved, does it make sense for one entity to make losses year after year after year? I mean, it doesn't make sense from an arm's length perspective, you know, and at arm's length, a party would not agree to make losses every year. So it just doesn't make sense. So that's an important step in transfer pricing that some people, some practitioners or some companies don't go through. So BEPS, you might have heard of this acronym. It stands for the Belgian Equine Practitioners Society. So this is a big society. When I mentioned to you I was in Belgium, and no, I'm just kidding. It stands for Base Erosion Profit Shifting, but it does also stand for the Equine Practitioner Society as well. That's a real thing in Belgium. I was, when I did some research and I Googled BEPS, I found it right at the top of my search. So I thought it was interesting. So BEPS is all about, it's an initiative undertaken by the OECD and G20 countries to create a single consensus-based international tax rules. This is much broader than transfer pricing, of course, but transfer pricing is a key part of BEPS. So I wanted to highlight that. A lot of it has to do with increasing transparency on the tax area, you know, minimizing treaty shopping, But there's a perception that, and it's probably a realistic perception, that in some cases, some companies abuse transfer pricing rules, potentially by movement of intangibles, or just really trying to create a strained analysis that seeks to minimize how much income to attribute to certain types of entities that happen to be in high tax jurisdictions, and putting more income artificially in low tax jurisdictions. So BEPS, the transfer pricing initiatives within BEPS are geared towards increasing transparency and increasing the ability of countries to review company transfer pricing policies and evaluate them and either get comfortable that the transfer pricing is arm's length, or have them be able to substantiate adjustments that equalize and make it fairer for countries. So transfer pricing, as you can imagine, leads to potential areas of controversy. These are some examples. This is not everything that's out there, but typical examples are intercompany services. I can't tell you how many times I've worked with a company where either the recipient of the services, the country receiving the services, the tax authorities deny the deductions for those services because in their view, the services didn't add any value in that country. So therefore there's no deduction. So when that happens, and a lot of times just in general, when tax authorities get a point of view, whether it be the Canadian Revenue Authority or the IRS or wherever, it's really hard to get them off that. So your best bet is to try to prepare documentation up front that shows that you thought through, in this instance, how the services were calculated, the service charges were calculated. That shows that you really thought through what the services are and how they create value. So on the service provider side, that's where the IRS came in back in the mid 2000s. The Internal Revenue Service in the U.S. Released thick regulations on intercompany services because they're concerned that U.S. multinationals aren't charging enough for the services that are being provided from the U.S. to foreign affiliates. So then there you have the tension between service recipient and service provider. Intangible property is a huge issue. And so just again, I'll just talk about it from the US perspective, but think about wherever country you're sitting in, be it Germany or Japan or wherever. If there's an intangible that's been developed in your country and the company either sells the entire intangible or a portion of the interest in the intangible, the concern there is it being transferred below arm's length value? Once the intangible is gone, it's the last opportunity for that tax authority to tax it. So they're very concerned about any kind of value associated with any intangible property that's transferred over. Supply chain restructurings, M&A, so all these types of issues can create potential areas of controversy. So tax administrations are making taxpayers identify exposures for them. So these new legislation is designed to increase transparency, as we talked about. There's a CBC reporting that applies to larger companies. 800 million euro, I think, is the threat, or 850 million euro. I forget exactly what the number is. But when I have a client that in the US, I think it's 850 million. I had a company that was in 1 year they were 600 million, and all of a sudden they were 1.2 billion. So they zoomed right past that threshold, and all of a sudden had to do CBC reporting. So something to watch out for large, fast-growing companies. So this will just basically naturally creates even more tension and more controversy in the transfer pricing arena. So what types of companies need transfer pricing services? Pretty much all types of companies. My clients range from really tiny, $1.5 million entrepreneur, but that has R&D in, like, for example, Argentina. They have an entity in Argentina that does software development for the US entity. So even at that size, transfer pricing, there's no threshold for most countries. Some countries do, like the UK does have some thresholds, but unfortunately, most countries, including the US, do not have thresholds for transfer pricing. So from small to mid-market, I talked to you about a mid-market company that I'm working with, and then the large companies, of course, have tons of transfer pricing issues. And those are the ones that you hear about, the Amazons, Starbucks, 3M. But the mid-market also is rife for controversy as well. And there, you could say that tax authorities might be spending a little bit more time there because they see companies that are less prepared than the larger multinationals, which are typically very well armed with transfer pricing documentation. So this is an opportunity for TGS to step in and own some of that mid-market to create value there. So just to kind of put up some examples of small business unit value chain examples, just a simple example, I mentioned already, software development is a typical one that involves US headquarter entities, where software development's happening in Romania or Argentina or some other country, and they're providing the US with the technology. Then to continue on that value chain, third-party suppliers, let's say the software is part of a larger machine that's produced in the US, and then you have third-party suppliers supplying raw materials to manufacture that machine in the US. And then the US manufacturer has a distributor in Canada. So there are two pieces to the transfer pricing here. There's the software development services that are being provided to the US. And then after the US manufactures the product, they sell the product to the Canadian distributor. So two different items. So usually the software development happens as a markup on the software developer's costs. So it's a markup on costs. And then the way we would set up this transfer pricing, typically you would expect the distributor to earn some kind of arm's length operating margin. So the US manufacturer would set a price that would enable the distributor to earn, I'll say, a 3 or 4 or 5% operating margin usually. This shows a different flow where you have a manufacturer, a headquarters company in Germany here. So third-party suppliers providing to a German manufacturer with a US distributor here. So the US, so in this case, this is called an inbound transaction because it's coming into the US. From our perspective, it's an inbound transaction. And so here you have the transfer price here would be the selling price that the manufacturing company sells to the distributor. We had a case last year where the company thought, oh yeah, I'm good in the US, I'm earning 12% operating margin. The German tax authorities came in and said, nope, you're earning too much profit in the US. We want to tax a part of that. So anything above and beyond, I can't remember exactly what percentage they came up with, but let's say anything above 6 or 7% was taxed in Germany. So double taxation. I just put this up here. I'm not going to walk through the entire flows here, but you can imagine that the larger the company gets, the more complicated its value chain gets. And actually, this is one of our clients. I changed the names of the entities, of course, but this represents some of the flows that we're dealing with. And then it gets really complicated when you have different types of flows. So here, tangible goods flows are shown in blue. The dotted green lines are intangible licensing. So it shows here that the US headquarters company is charging a royalty to the manufacturing company in China because it's not involved in the flows there, so it has to charge for the technology. And then here, there's a Mexican, too bad Horacio's not here because he talked about maquiladoras, but here's a maquiladora providing manufacturing services to the US for a fee. So this is an example. In this company, we use quite a few TGS affiliates to serve this company. Because we had, the reality was we had Spain, we had Mexico, China, and a few others, Argentina. They were all involved in this, and it really created a good solution. This company, which is about a $1.2 billion company now, they used to use the Big Four, and now they just use us, the TGS group, so whoever we plug in there to address their global transfer pricing. I mentioned before large companies. These companies typically for transfer pricing use multiple firms. So there's room for us in there. They'll probably use the Big Four for any high risk, high impact transactions, but they might have some lower ones, some smaller transactions as well. So those are opportunities for us to pick off and get involved. And a lot of times these larger companies are hungry for alternatives to the Big Four. So plenty of opportunity for us to play. They're not my favorite a lot of times. They can be difficult to work with. They sometimes have all these systems you need to learn how to log into and create invoicing and such. And I'm not the admin is not my favorite thing to do. So, but they're out there, and there are opportunities for us to serve these larger companies. Industries, a lot of times I get questions about what industries apply. Pretty much every industry. It's agnostic to industries. I mean, but these are some of the ones we typically see. Of course, manufacturing, software is a big one for us. Because these tend to be smaller companies that are global or cross-border transactions, where software development's happening in lower cost countries. Retail, energy, oil and gas. Somebody asked me, there's a travel agency that we have here in the US, and somebody asked me, well, somebody said, well, there's no transfer pricing there, they're not a manufacturer. Well, they're a global agency that has entities all over the world, and the US entity provides services to those other entities. So yes, transfer pricing, if there are entities in the group and they're transacting between each other, transfer pricing applies. So I mentioned earlier, it can help to think about transfer pricing from both an inbound and an outbound perspective. So think about yourself in your country and what kind of companies are headquartered in your country. So that's what we mean by outbound. So usually when you're thinking about outbound, you're thinking a lot more broadly than inbound, because outbound involves the headquarters company, and you're not only concerned about the transactions that are happening between your country and other countries, but also the transactions that are happening offshore as well matter as well, usually, because it's impacting the overall transfer pricing and tax posture of the overall company. So that's can be more interesting in the perspective of having a headquarters company that you're looking at, because you're really concerned about which entities own the company's intangible assets. Is the company charging out services that benefit affiliates? If it's not, then it should be. But then you need to do it in a way where you're able to get the deduction on the other side of the transaction. I mentioned loans versus capital contributions. Is the company entering new markets? So any changes in the company, so the more of the strategy of the company is very much something that you would need to want to understand to serve a headquarters company really well that's in your country. So typically for inbound, so on the other side, when you're looking at inbound, it's more specific to usually what the entities are doing in your country. So an inbound is usually involves a foreign parent company that has an entity in your country. So I'll just talk about the US because it's easier for me to talk about that way, but you can replace the US with any country. So here, typical inbound activities that are in your country would be distribution is very typical. So I mentioned earlier, a German parent company manufacturing product and selling it into the US for distribution. So that's a typical inbound activity for the US. Services can also be an inbound activity. So we can provide sales support or R&D from your country. I mentioned Romania providing R&D services for the US. So the US can also provide R&D services or other types of services to other countries. A typical one in the US might be sales support. So instead of distribution, where the US entity takes title to goods and sells them to customers, you might just have one or two sales support people in the US that are helping with the sales transaction, but they're not really distributors. So in that case, they're considered sales and marketing support services. And the way that that type of function would be remunerated would be charging out the country, in this case, maybe Germany, the German manufacturer in this case, would be charged a markup on the sales support services, as opposed to the distribution activity, where the distribution activity would earn an operating margin. And then, of course, manufacturing could also be an inbound activity. So on the left there, the table on the left lists out some of the areas to think about in terms of losses. So if you have losses in your country, you're at high risk, and it's also tax inefficient, especially if the other entities are profitable. If you're at low profit levels, then potentially you're at risk of IRS adjustments, because the IRS is paying attention to US affiliates of foreign countries earning too little profit. So if you either losses or low level of profit, there's a pretty good chance that the IRS will come in and look for adjustments. And adjustments, so if the IRS, if the company doesn't have a transfer pricing study to back up where its profitability level is laying, the IRS then has the leeway to do their own analysis. And what they will do is they will make an adjustment to the median of the comparables ranges. That's part of the 482, is they have the authority to adjust to the median of their range. And then I mentioned earlier, high profit levels. We think, okay, my entity in the US is making a ton of money, so there's no risk there. That's not true, as we talked about earlier. So first of all, if you're paying too much, US is, used to be on the higher end of tax rates. It's not anymore, but it can be depending on which country it's involved with. It likely has a higher tax rate than the other countries. So you're basically overpaying tax potentially, and then you're potentially at risk overseas. So then the last section here is to talk about how we deliver transfer pricing services and establishing arm's length pricing. So the 3 steps that we follow. The first step is, it's not unlike any other type of project or analysis, is we first start with collecting and aggregating data, and we use surveys, information requests, of course, discussions with management. Financials are important. Understanding the history of the company, looking at projections as well, so historical and projections, and then of course any kind of data that the company has that we could use as comparables would be important to understand. We may or may not use that data depending on the reliability of the data, but we need to make sure we gather that information so that we can evaluate it. So again, the first step is to collect and aggregate the data. Then once we have data, we analyze it, of course. And so we will look at trends, we'll look at analytics. We need to do a functional analysis where we understand the functions and the risks and the assets that are involved in the value chain. Look at the comparables that we identified and evaluate whether we can apply any of the transfer pricing methods. And then potentially more and more, like, and this ties into BEPS, looking at profit splits. So in transfer pricing, you can think about price setting, so how to set up the pricing. And then also we look at price testing. So testing is at the end of the day, the year is over, did the setting of transfer pricing result in an appropriate level of profit split among the entities? So we might use the profit split analysis as kind of a litmus test to see if the way the transfer pricing was set up, see if the results make sense. And then importantly, prepare or update documentation. So prepare documentation if they don't have any, update it if they do. And so there's some thought there in terms of how to organize the documentation, either by business unit, what level of documentation to have globally versus regionally versus country specific. So, especially the larger multinationals, they might have transfer pricing all over the place, disorganized, prepared by multiple different firms. Other companies might be extremely organized. So you see the gambit out there in terms of organization. And so there's an opportunity there for us to do some consulting around organizing the transfer pricing. I can't tell you how many companies I've run into where I ask them if they have intercompany agreements in place, and the answer frequently is yes, we just don't know where they are. Okay, well, if we can't find them, how are we gonna follow them? And so it just creates all kinds of unnecessary stress in the organization when they're not as organized as they should be. So here we lay out functional analysis, which is a key part of the transfer pricing study. And it really is making sure that we understand what's happening within the country for each entity. So each entity understand the functions, which the functions usually takes the form of people, what their roles or responsibilities are, and then their risks. So looking at the intercompany agreements, or if they don't have intercompany agreements, looking at the transactions and talking through, identifying what the risks are and which entities are bearing those risks and which entities are managing the risks. And then the assets, including and especially the high value intangibles. On top of that, we would look at the industry and the trends in the industry to infer those three aspects, and competition. So the functional analysis is critical to the transfer pricing analysis. So it's the opportunity. So part of transfer pricing is telling a story. So it's one thing to gather the data and apply the methods, but on top of that, you want to be able to tell a story, and that really strengthens when you can tell a good story and have the logic flow really well. That's how you know you're in really good shape. You can never get rid of all the risk in transfer pricing, but essentially the goal of having documentation in place is to say, you know what, we've really thought about this. We have a very strong and robust analysis. So tax authority, go somewhere else because you're not likely to get an adjustment here because of all the hard work that we've done here to put things in place. This slide summarizes, it's called a DEMPE analysis, and this is part of the BEPS initiative. And I think Michael talked about this yesterday within global intangibles management, and it fits right into transfer pricing. It's an important part of BEPS because one of the complaints from the G20 and non-OECD countries that are pushing for BEPS is that there are certain activities that generate intangibles or play an important role in the value of intangibles, and countries are not getting their fair share of the value that they create. So that led to a DEMPE analysis. So DEMPE stands for development, enhancement, maintenance, protection, and exploitation. So those are the five aspects of intangibles development and management that have been identified as part of BEPS. So this illustrates how we would map out, first of all, what is the IP? That's an important step, of course. And it's amazingly you have to say that, but sometimes companies don't know what their IP is, and much less who owns them. So so what is the IP? Which entities own the IP economically? Which entities own the IP legally? And they can be different. I mentioned earlier charging out of R&D, even though the Belgian entity in that example didn't legally own the IP, economically they certainly did because they paid for the R&D. So that's the difference there. And so then for each of these, each entity, which functions did it to perform to develop the IP? Which entities paid for the development of IP? Historically, that's how a lot of companies did tax planning, is especially US multinationals. If they wanted their Irish entity to own the IP, they'd put maybe 2 accountants in Ireland and then have that entity pay for intangibles and then have it earn a ton of money associated with intangibles. That type of planning is part of what BEPS was trying to take away. Is it's not enough to just merely fund the development of IP. You also need to have the people there. So in other words, R&D people that can direct the R&D, or attorneys that can help protect the IP, the patents and such. So you need to be able to show that you have some substance there in the form of DEMPE functions. I put this slide in here just to kind of illustrate, just to talk about sort of the concept here of profit definitions. And I think this is an important thing to understand here. And I talked about routine profit. And so when we think about routine profit, we think about profit earned by entities that perform routine activities and do not own unique intangible property. So we think about transfer pricing and applying transfer pricing and designing a transfer pricing system. We first look at routine entities. Think about a routine distributor or a routine manufacturer or a routine service provider that performs basically activities that are more easily benchmarked than other activities or intangible, high value intangible property. And so that leads to residual profit or residual loss. And that's the profit or loss earned from entrepreneurial risk taking and the ownership of routine intangible property. So those are the things to think about. And then BEPS tries to look at some of that residual profit and assigning it to potentially some of those routine functions that contributed to the IP through that DEMPE analysis. So that's kind of how we tie everything together here. So we took last year, we made an effort to try to understand what's happening within TGS and transfer pricing. And it's all over the board in terms of some firms do transfer pricing quite a bit and have subscriptions to data. And that's one of the tests for me, is to what extent does a firm subscribe to its own data? Because I think that that's a key to showing that you're really serious, you're really into transfer pricing, is you're actually paying for data that you use for your analysis. So we mapped out some of the subscriptions that we found out there. So there's quite a bit out there already. Some firms don't do transfer pricing at all. Some firms, they are comfortable with, Japan mentioned that they don't do transfer pricing, but they're comfortable reviewing it. So in that instance, what we could do, depending on the company and the risks involved, we could probably prepare the transfer pricing local file, the Japan local file in the US, and then have the TGS Japan review it for their purposes and provide input into it. I mentioned to you earlier, we're kind of winding down here, and so we're winding down in terms of time. So just a couple of things to mention here. We've at Transportal, we've developed a technology to help companies organize their transfer pricing. I mentioned to you earlier that some of the larger companies are extremely disorganized with their transfer pricing. They've got documentation being prepared in other countries. They don't know they're not managing it. They don't know where it is. So this is a technology that we've developed to help them organize, manage, and organize and manage their transfer pricing. We've also layered in some analysis, some analytical tools, and some automation tools to help facilitate transfer pricing. So Transportal is a global transfer pricing management platform that's geared towards larger companies. I would say any company, I would say the threshold for Transportal would be a company that is subject to the CBC reporting or larger. So $800 million, $850 million or larger in revenues could be a good target for Transportal. So just kind of tying this back to the TGS Global Network, I mentioned to you the survey that we did. So the experience level by country, high experience, specialized full-time economists with access to data. At the other end of the spectrum, we have review and collaborate. They don't have a lot of experience, but they're comfortable enough to review and provide input. And then medium was part-time with some access to data. So where TGS doesn't have the specialized experience in transfer pricing, a firm, if you don't have that in a certain country, then we can pull in Quantera Global or other firms that we have in our relationships to work with TGS firms, or you can TGS firm in that country can try to recruit or identify transfer pricing resources that can work with it. So this kind of talks about how we can potentially take next steps to try to organize a global TGS transfer pricing network. We work very well. That's one of the things that we've learned how to do, is to work very collaboratively, of course, with our clients, but also with other firms. It's really important to work collaboratively. And most of the time I have good experiences. I do have some difficult experiences that I've run into where, if I had one firm that sort of was a loose cannon and really hurt my relationship with the client to the extent that I lost the client. And so those are the ones where you learn, okay, that they're not good at collaborating. And so it's really essential to have a very collaborative type attitude in transfer pricing. Otherwise, relationships can get broken. And I can assure you that I have that mindset. So I will not hurt anybody's relationship. I will work with you to serve your clients. And one of the ways we can partner together is to develop marketing tools. And here's one here. This is kind of I call it a cheat sheet, but it can have all the key talking points that you can have to talk about transfer pricing, what it is, why it's important, who needs it, and why do you need documentation. And then you can, here I have my contact information, but you can put your contact, we can share this with you, and you can substitute your contact information. We can tailor it for your country, because this is a little bit kind of tailored to the US. It wouldn't take much though to change it for other countries. So again, this is something, a tool that we can make available to different firms to market transfer pricing. So that's it. There's a few minutes here for Q&A. Did any questions come in or comments come in, guys?
Wonderful, Guy. Thank you. That was a really, really excellent presentation. And I was thinking people are going to absorb the information, I'm sure, and have questions for you. And maybe what we can do as a trailblazing experiment for transfer pricing is if we collect questions from people and we canvass the members over the next few days for more questions after they've watched your webinar and Michael's as well. We can have another session, a live session with Guy and with Michael's to answer your questions. Yeah, so that we can have the stack of questions. So, because I think we need a discussion about it and how we can move forward with building the transfer pricing group.
I would agree. Yeah, that makes a lot of sense.
Yeah, that's a great idea, Andrew. I'd be happy to do that.
Okay, that's excellent. So I made a note of that. And what I'll do is I'll make sure your presentations are seen in the right places. And anyone here, if you have questions that you would like to ask, could you email them to or direct message them to me, and we'll set that up for maybe next week. That we have a discussion session about setting up these work groups, because we have to get off the Zoom link so that we can have the plenary session this afternoon.
Right.
But again, Guy, thank you very much. That was excellent. It's you could be forgiven for thinking that transfer pricing is a dry subject, but you're obviously very passionate about it, and that comes through in the preson. And it's obviously earned you enough money to have a fantastic house on the beach.
This is my view.
Yeah. So that's fantastic. Okay, everybody, thank you very much. Rarely we've got no comments from the audience, but I think everybody is just speechless and spellbound. And we'll set up the asynchronous discussion section for next week. And thank you very much.
Thanks.
Thank you.
Thank you.
Thank you. Goodbye.
Thank you, everybody.
Bye.
Thank you, Jean-Philippe, Justin, Rodrigo, Christos.
Au revoir.
Bye-bye.
Au revoir.
Thank you.
Merci beaucoup.
Bye-bye. Thanks.